morning, everyone, and thank you for joining us on Morning Markets from True Potential. Today we're going to focus in on inflation, US and the UK. Paul mentioned yesterday how the market would be looking to the US inflation numbers to assess whether some of those transitory elements were starting to roll off. So let's dig into the US number first. What did we see yesterday? We saw CPI at the headline level increasing 5.3% year on year. We look at it at a core level, which excludes the more volatile food and energy components. We saw overall CPI increasing 4% year on year. So the rate of change has slowed both on a year on year basis and on a month on month basis. And indeed, that's the slowest increase that we've seen in August since January of this year. Looking at some of those components that have been driving the higher rate of inflation, some of those that have been described as transitory or temporary, we think about used cars in particular in that. We did see a bit of a decline starting to come through there. If we look at it on a year-on-year basis, still up over a third, but declining month on month. And if we take that back to June, with used car prices increasing 45% year on year. So really that's starting to wash its way through. The other area where we saw weaker pricing was coming through in airfares, which had fallen about 9 to 10%. Again, that's reflective of some of the COVID dynamics in the economy as well, continuing to be very evident there. So the potential there is for further declines in some of those factors over the coming months, and that should help that overall rate of inflation decline. I think it's also just worth mentioning, however, that it may be that inflation does settle at a slightly higher level than has been expected, and some of that may be due to how the housing effects start to feed into the data, particularly rental costs. We've seen very strong house prices in the US. It would be unusual for that not to feed into rental increases going forward. Turning then to the UK, keeping that view on inflation, again, a very step change in the UK inflation rate for the month of August, increasing 3.2% year on year from the 2% that we saw in July. It's a significant increase, but a large part of that can be attributed to that term, the base effect, or what was happening in August of last year. If we think it back, cast our minds back to then, with VAT reduction on food, we also had the Eat Out to Help Out scheme working its way through. And as you can see in the chart just on the screen at the moment, a large component of that increase that we're seeing in August is really driven by two factors there. You can see that in terms of recreation and culture, but also restaurants, and that really driving that impact. So that is a bit that one wouldn't expect to see repeated into the September numbers, but again, it just highlights the sensitivity of data at this point in time to base effects and changes within particular sectors. The only other thing I wanted to mention this morning is Asia, where we've seen a mixed performance today. Further regulatory change within China impacting the casino sector within Macau, and also some economic data that really does highlight how sensitive the Chinese economy has been to some of those COVID measures that we've discussed, where we saw retail sales really coming in quite weak, up 2.5% year on year. They were 8.5% last month, and also industrial production was disappointing, coming in at 5.3% versus that 6.4% last month. I'll leave it there. Please do join us again tomorrow. Many thanks.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.